Hello and welcome to another video by reitspro.com, a channel where we give you lots of insights on REITs and InvITs in India. And also you can go to our website and have a look at a lot of resources, blogs and WhatsApp group, as well as links to my books, which are Real Estate Investment and Financial Analysis and REITs and InvITs, What's New in the Stock Markets. So today the topic is about interest rates and REITs and InvITs. How are these two related? In relation to REITs and InvITs, REITs invest in rent-generating completed commercial real estate assets, while InvITs invest in revenue-generating completed infrastructure assets. They both are traded in forms of shares or units, as they're called, on stock exchanges, and unit holders own undivided share of the assets held in a REIT or an InvIT, and they derive regular income therefrom. And the topic about the inverse relationship of REITs and InvITs with interest rates we'll explore. Is that a truth or a myth? So a myth is generally an idea or a story which people believe, but that may or may not exist. For example, I have here for you two examples, very recent examples here, where we talk about the interest rates. These are 10-year bonds in India, a graph of the 10-year bonds from 2020 to now on, showing a rise in interest rates over a period of time. This is an extrapolation of the same graph. So if you look at the graphs, the amount of increase in interest rates has been phenomenal. However, the story also goes that real estate is inversely proportional to interest rates, because as interest rates go up, so do the price of loans, and real estate does not find buyers. But is that really true? Because we all see in India that real estate has been on the upswing. The second example I'd like to share is that this is a graph of one asset cycle leading to the other. So if you have interest rates, rising interest rates, then you can have declining share prices, declining commodity prices, and tighter money and so on. This is a general graph of how boom to recession and to recovery can happen. But is this really happening in India today? So the interest rates are on the rise, the stock market's on the rise, commodities are rising, as well as the real estate prices are rising. A lot of times what we hear in theory may not turn out to be true. There can be reasons that can be attributed to these later on. For example, here we can say that there's excess liquidity, there's pent-up COVID demand, and so on. So interest rate inverse relationship similarly may not be that profound or evident in reality, because we are actually looking at interest rates from the perspective of inflation. So when there is high inflation, naturally there is higher interest rates. We are looking at that kind of a perspective. In any case, when we have DCF or the discounted cash flow analysis or the valuations of different assets, everything would go down. So even equities would go down when you are looking at the DCF analysis, and the prices and the interest rates go up. But here we are going to restrict ourselves for to InvITs and REITs only. So we are going to talk about interest rates and InvITs and REITs, how the two would be related specifically. So if you look at InvITs, they have a large steady income, because mainly the InvITs in India today are fixed contracts, though the nature is also changing right now. And REITs, the rates are as per the market, because the REITs are mainly about renting out commercial real estate, and the market determined rates are there. So we'll take up InvITs and REITs subsequently, one by one, to see the impact of interest rates on these two. So taking up InvITs with a DCF valuation, which is generally the case, would have large steady inflows because of fixed contracts, and the main impact would be debt component, because if you look at the future cash flows, then any change in the discount rate or the interest rate, as they call it, the current interest rate, would decrease today's value of assets. So if you understand what DCF analysis is, then you can see this. Otherwise, simply when the interest rate goes up, then the value of the asset today would go down, because we are putting a larger discount to all future cash flows, which here in case of InvITs are mainly steady. In case of some InvITs today, because 2017 we had IRB InvIT and Indigrid InvIT, those two have shown that the asset mix is in fact changing. So Indigrid was mainly into PTA or power transmission assets with fixed flows, but they are also getting into production assets, variables. In fact, and they are also going into renewables also. Now IRB InvIT was primarily a road asset, a build, operate, transfer, where there was a variable return. However, they are getting into more of HAM or hybrid annuity models, largely fixed ones. I've made a separate video on what a HAM is and about IRB InvIT. If you want, you can watch that. So the asset mix is generally changing, and you need to evaluate whether we are looking at a fixed flows model or a variable one, which is dependent on the interest rates in the market. And inverse relationship is not that strong in case of REITs as in general, because you have steady flows which are medium term, but renewals are as per market. So typically a REIT would have, say, a commercial office space would have a 3+3+3 lease, where after 3 years the rental would increase as per the norms, 12-15% or whatever, and there would be a clause of expiry of lease. So for the time that the lease is fixed, they would have contracts in the medium term which are constant, increasing as per the contract. And as the lease comes up for renewal, then the market rents would be charged. So the inverse relationship does not become that strong. Why? Because as the market increases, if the inflation is more, the rentals would be more. So we'll explain that in a bit on that account also. So what will happen is that if you have 4 REITs today in the market, broad criteria would be these 3. So there'll be a debt structure which you need to evaluate, because a debt taken by a REIT for expansion or acquiring assets, the interest rate would change, go up or down as per the interest prevailing in the market, depending on whether it has a fixed or a variable debt structure, and how much percentage of debt is there. Secondly, the lease structure, how do the lease work out? How long are the leases? What is the quality of the lease and the tenant agreements? And third, the quality of the assets, which markets are they in, and how the change in infrastructure would impact them, and would that really make a difference, and interest rate would really make a difference or not. So if you see the debt structure, we have to look at the percentage of debt holdings and fixed versus floating costs. Secondly, if you're looking at leases or rental inflows, you'll have to see WALE, or the weighted average lease expiry. So what are the mark-to-market rental possibilities? So what happens is, if the average lease is for 6 years for the entire portfolio, then after 6 years, most things would come up for rent renewal. And then the interest rate impact would be absorbed, because the rentals would take shape accordingly. Thirdly, the asset quality also has a role to play, because the interest rate impact can be lowered, because if the economic growth is there and tenants are preferring a certain REIT, depending also on the geographical location, then the interest rate impact would really not be too much here. As an example, let's take up the case of Embassy REIT. So Embassy REIT has a debt structure like this. It has a 29% leverage, which is the loan to value ratio. And they also have a fixed rate debt of 60% and a floating rate debt of 40%, which means that as the interest rates go down, 40% of their debt is what is going to change. And the average cost of debt is 7.8%. So this is an example which can tell you how much of an interest rate change would impact the debt in the books of Embassy. The second thing is, we talk about the lease structure with 85% occupied and 6.8 years of WALE. 6.8 years is the average weighted average lease expiry, and they have a 10% mark to market opportunity. So here, as the leases expire, they will renew it on the market rates mostly, and that would lessen at that point of time the impact of interest rate increases. Third example is of the asset quality in case of Embassy REIT. So if you have an Embassy REIT 76% in Bangalore, and the whole ecosystem is moving supposedly to Bangalore, then at that point of time, the interest rate would have a little impact, because the assets and if the quality of the tenants is such that they require that property, then how much rental flexibility they have would become limited, because the assets, the quality assets would become limited, and the tenants would be willing to pay because it has a negligible impact on their overall balance sheet. So the how the asset is in demand would determine the rents and also lessen the impact of the interest rates. Summarily, assess how we can discount the interest rates into our whole equation of choosing REITs. So the first very important thing to understand is that price is definitely inversely related to interest rates in the short run. However, if you look at a holding period of a longer time span, which is what we feel that REITs are meant for, then you need to see the horizon and the comfort and the perspective of interest rates in that time span. Do not look at REITs for a shorter time span. Secondly, one needs to be very clear about the portfolio allocation and what role a REIT or an InvIT is having in its portfolio. So is it stability or diversification? Because if this is there, then obviously you're looking at things in a different way, and you're looking at steadier cash flows, and a little bit of changes in price due to interest rates should not matter to you. You should look at the longer term on the cash flows. And the third part is that after this broader perspective has been analyzed, then look at the individual analysis of REITs or InvITs, cash flow, stability, and these three criteria we talked about: debt, the lease structures, and assets, and so on. So if you like our videos, please do comment and do subscribe to our videos. Thank you so much for watching. Thank you.